Hello everyone, welcome to a new video at the start of the week. It's Monday the 2nd of December and I'm recording this just after the US markets have opened. My name is Julius de Kempenaer and I'm presenting from Amsterdam as usual. We completed the month of November. That means that we're going to take a look at the completed monthly charts for November, and it's also the start of the new month of December, the last month of the year. So one more chance to look at seasonality going into the last month of the year, so see what that brings us. And obviously we're going to tie all that together into relative rotation graphs, RRG, to see if we can find any outperformers or clear underperformers going into the end of the year. Let's get started. Starting with the monthly charts for all the sectors. And as you know, I'm using the indices, the underlying indices for this exercise, because they are not influenced by dividends and other corporate actions, and it gives me the most clear, purest picture of what's happening in an index. Usually these indexes are very, very close to the ETFs that we normally use, but for these longer term charts I prefer the indexes because it's just a little clearer picture. And another thing that I've noticed is a lot of people ask me how I do certain things. And if you look at this screen, for example, this is just my normal price chart as I've set it up. By the way, this is a public chart list, and we'll put the link in the description of this video. You can use it and get it to your own system. And you will get my annotations on the charts as well. And this list also has the indicators of the sector rotation model attached to it. Anyway, one of the things that I like to do is blow things up and make it bigger for you to see it. And as you can see, there's a lot of white space here on the left and the right of my chart. It's not a Stockcharts thing. It's more like a Windows or a Mac thing, but I'm working on a Windows machine. And the way I blow this up is I press Control and then I scroll up and I can zoom. Now this is a little bit too much, but I can zoom. And now I'm using, as I call it, maximum screen real estate. Basically, it's the zoom function of your browser that I like to use to fill up my screen with as much chart as I possibly can. Let's quickly go over the position of those monthly charts. And the first one here is communication services. It's one of the few sectors, together at the top of my head, real estate, that has not broken to new all-time highs yet. And for communication services, that is really a long time ago. As you can see here, the all-time high was set at the end of 1999, and we're now just about to push against that level. We're doing that for 2 months already. We haven't broken it yet. So this level here around, let's say 330, 335, I'm not very specific with these levels. For me, these are more ranges. So it's like 337. You could even argue that it's 340. The high here was 339.28, 337. Let's put it at 340 just to make sure. So 340 in the communication services sector index is a pretty crucial level to watch, because when that breaks, this sector is breaking to new all-time highs. And usually a break to new all-time highs is a pretty strong signal. Clearly the trend here is still up for this sector. Consumer discretionary has already made that move. Last month, consumer discretionary broke to new highs. And it did that with a vengeance. This is a pretty strong break, guys. This is a long bar, a long rally during the month. And we took out that overhead resistance level as if it was not there. And this is a level that is 3 years old. So November 2021 is 3 years old. That's again, it's not as old as communication services, but still, this is a pretty serious break. And obviously that uptrend here at nice higher highs and higher lows is in place. So consumer discretionary remains in an uptrend. Consumer staples already broke to new highs a couple of months ago, and it fell back. And then you can see that last month we kind of put in a new low. It looks as if we have a new higher low which has formed above the breakout level, which is good because it means that this former resistance level is now starting to act as support, and it underscores the positive trend for the consumer staples sector. And mind you, these monthly trends, we're talking about price trends. There's nothing relative about this. This is just looking at price trends, and at the end of the cycle, when we looked at all 11 sectors and the S&P, hopefully we get an idea of the overall trend in the market based on these longer term monthly charts. Here is the energy sector. Again, broke to new highs, started this year, but it then fell back. So this overhead resistance area here, and let's put that between 730, 740. You can even argue here, so the high here is 756. So this whole area around 740, 750 is pretty crucial for the energy sector index. The positive thing that I see here is that the lows are getting higher. So the highs are pretty much at the same level in the same area, but the lows are consecutively higher. So we've got higher lows and we've got highs at the same level. This is an ascending triangle. It's a bit long for an ascending triangle, but the philosophy, the rationale behind it remains the same. There's a lot of supply here. The demand comes in at a higher level each time. And this is kind of this spring that is, building up, a lot of tension building up. And as soon as that breaks, so as soon as the energy sector takes out that 740, 750 area, we can expect a pretty aggressive rally in the energy stocks. No, needless to say that the trend remains up. I mean, this is still higher highs and higher lows. Although they are in the same range, I rate this as higher highs, higher lows. The trend here is still higher. And then we have financials. Financials already broke to its all-time highs. That happened in June, July of this year. And we're following through. Last month was actually very strong, very long bar, very strong performance for the financial sector. So the uptrend here remains clearly intact. Healthcare also broke to new highs, let's say twice. So here the first time, that was at the start of the year. Then we broke it. We again, old resistance came back as support. Then we broke again to all-time highs. That happened in August. And now we're back to testing that former breakout level again. So yes, healthcare broke above an all-time high, but it dropped back and it's now testing that former resistance level as support. The trend is still there, trend's still up, but if you go back to the previous charts, it's not as nicely up as the others. As a matter of fact, if I would draw a short-term trend line here, and mind you, this is a monthly chart, so short-term here means more than a year's worth of data. I could argue that it has broken that uptrend, although there is no lower highs, lower lows yet, but there is trouble for healthcare. It's not as strong as it used to be, and it's certainly not as strong as other sectors in the universe. And then here, industrials are clearly a continuation of its series of higher highs and higher lows. It is continuing, and again had a very good month last month, broke to new highs, new closing high, and it's still trading around that level. So this uptrend remains fully intact. And then we have information technology, and you can see that technology broke to new highs in November 23, did it again, so fell back, did it again in May 2024, fell back, and you can see how this is a nice rising channel, although I don't like to draw, this is a log chart, so I'm not a big fan of these channels on these log charts, but nevertheless, what puzzles me more, or what engages me more, is the fact that the rhythm of higher highs and higher lows is in place. And we're now pushing against that overhead resistance that was set back in June. So that is around 4,500. 4,500 on the information technology sector index is an important level. Right now, market's under pressure there. You see resistance, so there's supply coming to the market around this level. It's already a couple of months old, it's a couple of months going. And in order for this trend to maintain its momentum, we should see a break higher. And the question is, because the last 3 months we've not been able to break higher. So the question is whether we can do that at short notice, or whether we will need to see a little bit more downside in the technology sector index. Again, mind you, this is all based on price. It's not relative, it's based on price. And as I wrote in my latest blog, is a question whether you can continue to move higher without the participation of the technology sector. I talked to you about that last week. And my conclusion was and still is that as long as technology, because technology is the largest sector, so if it really starts to move in a corrective way, i.e. lower prices, that will impact the price of SPY. There's no doubt about it. However, if the technology sector is able to maintain its current level and not see a massive decline or a serious decline, I think that the strength in other sectors will definitely be able to push the S&P higher without the participation of the technology sector index. And here we have materials. Again, this is a sector that broke to new highs a couple of months ago. It's still holding up above that breakout level, so old resistance is now acting as support, but it's not as strong. The series of higher highs and higher lows is still there. I think you could draw a trend line here. Again, it's a log chart, so I'm not a big fan of that. But the series, the rhythm of higher highs and higher lows is definitely still present, and a trend that sector remains in an uptrend in terms of price. And then here is real estate. This is a sector that is clearly well below its all-time high. So the all-time high was set back in December 2021. And we have now completed a big bottom formation and we are trading above that. So here also we see a situation where a sector has broken above previous highs, not all-time highs, but above previous highs. It's holding up there and we've actually tested that previous resistance as support. And we're now pushing against resistance, and that is around 280, what's that? 285, 285, around that area. So if real estate takes out 285, I think we're on the way to all the way back up to 325. All in all, this looks to be a nice turnaround out of a downtrend that started at the end of 2021, moved sideways, and then 4 or 5 months ago broke out, and we're still holding up. And last month we saw a rally out of a low that was against that breakout level to the resistance of the 2 month ago high, and we're waiting for a break higher. And then here is utilities. Again, broke to new highs a couple of months ago and still holding up there. 2 months ago we had a good test of old resistance working as support. So you see that theme coming back in a lot of sectors where we saw the breakout, and then after the breakout you fall back, you test the former breakout level as support, and now we're jumping higher. And what we need here in the utility sector is a break above, let's say, 420. 420 is the level to watch in the utility sector. And then that all comes back together in the chart of the S&P 500, and with all these sectors in uptrends, because there was none in a downtrend, not even a sideways one, even the ones that are pushing against resistance are still labeled in an uptrend. That is resulting in a continuous uptrend for the S&P 500. A lot of the dangers or warning signs that we talked about have evaporated, went up in thin air. Market is super strong, and you see this continuing. And again, last month pushed to new highs, and we're still holding up there. The fact that we broke higher and we now have solid support at certain levels at the previous lows makes this market only stronger. There's always a chance for a decline, but I don't think it's going to be massive and major, at least not on this monthly time frame. It's a little bit longer term and looks at longer term charts, but with all the sectors either breaking to new highs, breaking resistance levels, and even the ones that have broken to new highs a couple of months ago, they're still holding up above their breakout levels. So all in all, that remains a pretty positive outlook for the sectors as well as the S&P from a price perspective. And here is my seasonality spreadsheet with the seasonal outperformance in the top half and the relative performance of each sector in the bottom half, broken down by month. SPY, obviously, the S&P 500 is in absolute terms and everything else is in relative terms. Now, if you look at the line for December, we can see that 70% of the time SPY ended higher than it started. So, November and December are traditionally very good months for the stock market. And just looking ahead, things today look as if we will see another good month ahead. All things are looking good. We just looked at the monthly charts. All these uptrends are intact, so there's no reason to foresee weakness in December. If you look at the performances of the various sectors, it's interesting to see that there's a lot of 50, 45, 55, 50, 45, 59, 50, 55, and then 40 here. So let's break that down. That means that this is the group offensives, and the highest percentages are coming from financials and real estate. So from a seasonal perspective, the sectors financials and real estate, 60% of the time over the last 20 years have outperformed the S&P 500 in December. Communication services, almost 60%, 59%. But the technology sector, 40%, that means that 60% of the time the technology sector underperformed the S&P 500. And remember what we just talked about when we talked about the monthly charts. Everything is pretty good, but technology is pushing against resistance. And in my last video last week, I talked about, can the S&P rally without the participation of technology? And looking at the seasonal numbers, the answer, I think, is yes. Now, what are we looking at in terms of performance? So historically, the S&P gained 1% on average in December. If you look at the outperformance sectors, so financials and real estate, we see that both have picked up, so they've both outperformed the S&P 500. However, financials did that with only 40 bips, and real estate outperformed by 2.8%. That's a massive outperformance. That's the highest on the sheet whatsoever. And the way you should read this is that based on these numbers, it means that the expected performance for real estate in the month of December is 3.8% because it's 2% outperformance over the 1% positive performance of SPY. So combined, we're looking at an expected return for real estate of 3.8%. I'm not sure whether it's going to happen. It's the average. It's what happens when you spread it out over time. And there's obviously a big difference, a big gap between the highest and the lowest, but on average, this is a pretty strong month. Way less for the defensive sectors. So even, by the way, consumer discretionary with a 45% expected outperformance, so that's less than 50%, and has a negative expectation. If you look at defensives, the average performance is good, better, but the times that it happens is not that much. And that's why, for example, the 50 and the 45, I'm not that interested in because it's a bit of a flip of a coin what comes out of it. If you just look at the average, it's okay. It's not massive, it's okay. Go to sensitive. I think the two interesting readings here are for communication services and for technology. And for communication services, it's on the positive side because 59, 60% of the time, it's showing an outperformance over SPY in the month of December, and that outperformance is on average 70 basis points. So that means an expected return for communication services of 1.7% going into December. Technology, on the other hand, is expected to underperform 30 basis points. So 60% of the time, technology is underperforming the S&P 500, and the average number is 30 basis points. So the expected return for technology is a gain of 0.7%. Let that sink in. So it's a 30 bips underperformance, which happens 60% of the time, but it still means a 70 bips gain, 70 basis points gain for the technology sector. And if we bring that back into the question, can the market rally without the participation of technology? The answer is yes, because technology doesn't have to outperform. It just has to stay in line with the S&P 500, or as here based on seasonality, just slightly below it, only 30%. So it's still going up, but not as much. and it's still, a 70 bip gain in technology is still roughly 30% of 70 bips is a little over 20 basis points gain in the S&P 500 that's coming from the technology sector. So all in all, things are looking pretty good. I'm going to concentrate on the real estate sector from an outperformance point of view, as well as communication services, and to a lesser degree, the financials sector. From an underperformance perspective, we're looking at technology underperforming 30 basis points, and technology, although it's not that strong, 40 basis points. We're going to look at this on a relative rotation graph, and we're going to bring together the monthly trends, the seasonal pattern, and the current rotations. Now let's bring all this to a relative rotation graph, and I've loaded up the monthly data for the sectors, and we just established that the strength from a seasonal perspective should be coming from financials and real estate, to a lesser degree communication services, and then groups under pressure, definitely the technology sector, and to a lesser degree consumer discretionary. Let's see where these tails are. So let's start with financials, and I'm highlighting. So here's financials, and you can see this is a monthly tail, so this is going very, very slowly, and you can see that this is traveling to the right, which is picking up strength, picking up relative strength at a very stable momentum level. So this is a very stable relative uptrend, and it's expected to continue into that leading quadrant in the next month or after. So this is underscoring the positive expectation for the financial sector going into December. Now the second tail that we want to look at is for the real estate sector, and that is right here. That has just moved into the improving quadrant. It's coming from very low readings, has just overtaken consumer staples in terms of RS ratio, but it's at a positive heading and it's moving in the right direction. So with that strong expectation from a seasonal point of view, this tail underscores that strength. This is a situation where you can see a quick recovery, and if you remember the price chart of real estate that we looked at, we had that coming out of that decline, big bottom formation, breakout. If that breakout continues, and there's no reason why it shouldn't, it's going to help that relative strength, that relative trend, and that's what you see here on that RRG. That's what you see happening here. So financials and real estate are in pretty good shape for a good month of relative performance into December. Also, they have still a lot to go. They're not deep inside the leading quadrant, so they haven't already led the way for a long time. They're about to start leading, and that's a good point to start picking up relative performance. If we go to the communication services sector, that's the third one, you can see that that is already inside the leading quadrant and has rolled over. From a RS ratio reading perspective, this is the strongest sector, so it's the highest reading in terms of RS ratio, and that is usually a good sign. And then finally we have the technology sector, and that is right here inside weakening, and you can see how technology has led the way. It is now rolling over, and that is pretty much confirming with what we see on the seasonals, where technology is expected to be under pressure. And if you look at if you want to do some sort of a pair trade or overweight, underweight, think about like, what would it be like? This is kind of these scissor scenarios that you can very clearly see on an RRG, where real estate and or financials are rapidly picking up and technology is rapidly moving down. So overweighting real estate and financials versus technology, that could be a very nice leveraged move where you see a decreased performance or an underperformance for technology and an outperformance for real estate and financials. And that is how you use an RRG to pick sectors where to underweight or overweight or where to long and short. And this is actually a pretty nice example. The communication services sector, it's still good. The seasonals are good, but I wouldn't be surprised if it already had its run, because if you look at the rotation, you see that they are coming from a long way and they are now moving lower. So we could take a little bit of a granular look and bring all of this into a weekly RRG and see where these sectors end up when we do that. Let me highlight them. So we're going to do financials, we're going to do communication services, we're going to do technology and real estate, of course. Now, slightly different picture. Let's start with the stuff that's confirming. And here we see communication services actually making that nice move. So it's kind of contradicting the monthly reading, and it's confirming what we see on the seasonals. So does financials. That's also confirming the strength. You can see that financials was on the left-hand side on the monthly, but it's already deep inside leading on the weekly. Communication services was rolling over, but you can see that it's picking up again. And then you see technology is also confirming because it's the weaker end on the monthly. The technology tail is inside weakening and moving towards lagging. And here you see how technology is rolling over inside the improving quadrant, rapidly heading back towards lagging. So this is definitely underscoring the weakness for the technology sector. And then we've got real estate, which is interesting because it's inside weakening. It's inside improving on the monthly. With these strong seasonals, what we need to see here is a very rapid turn of real estate back up. Preferably while still inside the weakening quadrant. It's probably going to be tight, but still possible for real estate to turn back up and move its way back into the leading quadrant. So from a, let's say, reliability point of view, I think that financials is probably the best, and technology as well on the underperformance sector. So financials, best, most reliable on the outperformance, technology, most reliable on the underperformance, and then communication services and real estate, a bit of a wild card vis-a-vis each other. Anyway, this is an interesting look. We took a look at the longer term trends. We looked at them on the relative rotation graphs, price charts, and here is the seasonal point of view for those four sectors where real estate, communication services, financials are expected to outperform, and technology is the only sector expected to underperform in the month of December. That's probably not going to hurt the S&P, so we're very likely looking at a strong move towards the end of the year. Thank you for watching, and please leave your thoughts in the comments below this video, and I'm looking forward to seeing you again next week, same time, same place.